Tata Motors, Dinesh Pal, Executive Director, Tata Motors, Shailesh Chandra, MD, Tata Motors, Limited, Mr. Adrian Mahe, CFO, Jaguar Land Rover, and my colleagues from the Investor Relations team. Today we plan to walk you through the earnings presentation followed by Q&A. As a reminder, all participant lines will be in listen-only mode, and we will be taking questions via the Teams platform, which is already open for you to submit your questions. You are requested to mention your name and the name of the organization you represent while submitting the question. I now hand over to Balaji to begin the presentation.
Thank you. Firstly, thanks everybody for taking the time to join the session. And as customary, we quickly cover the presentation first, assuming that you have gone through it or had a personal glance at it. And obviously, spend as much time as possible on it. And in the statement, you're well aware of nothing new there. Just again, a reminder to everybody that the way the numbers are being presented is consolidated view downwards into Tata branded commercial vehicles anywhere in the world, Tata passengers, Tata branded passenger vehicles anywhere in the world, Jaguar and Rover vehicles, that's all verticals are done. No change in that, just a reminder. Again, it's been another intense period for us, both in TML and in JLR. And one of the follow-ups I want to make is in terms of the incorporation of smart mobility solutions, particularly for managing the GCC business of the government and the first day transport undertaking. And of course, the EV portfolio continues to expand on the market, next on EV prime. And JLR for the Defender 130 launch to talk about later this quarter. And the focus continues to deliver results for us. And the order bank grows to a new record of 400,000 units. Next slide, please. For the financials, let me start by putting it in context that it has been a disappointing quarter for us. And we are well aware of these numbers did not match our own expectations when we started the quarter. Yes, there is a fair amount of challenges of semiconductors and COVID-related lockdown that we have to deal with. But at the same time, the one that really was the was the ramp up, the slower than expected ramp up that we had in Range Rover and Range Rover Sport. And I'm going to talk about it in a coming plan. But as we end the quarter and we enter into we believe we are strongly taken. And therefore, are quite confident of how the current quarter is going to land up. And that's for the future. Let's quickly delve into Q1. Growth of 48% in both sales, about 8% revenue growth, and the PBT before exceptional item of about 1,500 crores and JLR on pension related matters that Adrian will talk about in the backlog and forecast. It is deteriorated by about 90% year-on-year, and EBIT percentage is about 60% improvement compared to last year's same time. Is something that could have been better. And next year, on a outflow basis of about 9,800 crores, most of it is working capital, so not particularly worried about. In fact, obviously, the numbers also got impacted by the revaluation of FX and commodity hedges in the highly volatile FX and commodity markets. Next slide. Source of growth, if you look at it, we grew about 8% in revenue terms, volume and price contributing roughly 50-50, and translation took away a lot of it, basically pound sterling depreciating a lot due to the Indian rupee, and therefore that's what we see as a 4.3% in the translation. The profitability improvement, most of the claims aspired with CV, PV and the others, and of course JLR took down their profitability because of their challenges that they had, and fuel turnaround this quarter. Their automotive debt went up from 48,700 to about 60,700 crores, almost entirely explained by working capital, about 2,000 crores of underlying external debt that is there to 34,800, but that should reverse once the profitability improves. With this, let me now hand it over to Adrian to take you in JLR and capability. Adrian.
Yeah, many thanks, Balaji. Next slide, please. Okay, so this is a six quadrant, as Balaji said, disappointing quarter for us in Q1. Retail's well balanced, to say. So as you'll see in the presentation, we have no concerns about demand and retail levels at all. Okay, so these are the key performance highlights. I've mentioned some of them. Order banks, as you mentioned, up to 200,000 units. We will take you through that. There is a pensions benefit for the re-establishment of our future pension liabilities at an inflation level of CPI rather than RPI. That's excluded from that loss before tax because it's non-EBIT related. A refocus program continues to go well. I will take you through that. And the liquidity continues to be strong, 3.7 billion cash on hand and a 1.5 billion revolving credit facility from July 2022. So total liquidity, 5 billion plus. Next slide, please. Okay, so this is our retails and our wholesales in quarter one. By brand, we broke this out we used to refer this to nameplate families. We're now referencing this as individual brands. Retails at the top there, you see a flat, and they're pretty much flat across all of the brands. Obviously, that's retails being fed from dealer inventory. I do have an inventory slide later, and there's some things on there that hopefully you'll see as this starting to turn around for us. Wholesales, this really lands on the point about our Range Rover and our Range Rover Sport. You can see there in the Range Rover brand, wholesales are the lowest quarter-over-quarter versus last year. That's where we've fallen because we haven't been able to build up the production in that new facility. I'll talk to that later, as well as fast as we would have wished. And that's really the story behind the total wholesale reduction in the quarter. Defender was stronger than previous quarters and last year, as that plant Nitra is getting closer to a level of production than any other plant at the moment. Next slide, please. And this is the same data, but it now broken down by regional sales, retails again at the top. And what you see here, which, knowing our profile of what we sell where is corroboratory to the last page, we've done weakest in our regions that are most reliant on our Range Rover and our Range Rover Sport because of our inability to ramp those products up at the speed we would have wished. So North America is down significantly, heavy Range Rover Sport region. So is China down, heavy Range Rover Sport region, and also snippets of overseas. We've done better actually in the quarter in the regions that take the other products from other plants, i.e. SU2 and 3 in Europe and the UK. And the wholesale data you see there as well. I won't go through that all in detail. It's a version of what I've said before. You see China down again because of that Range Rover Sport numbers there. Electrified data up 2% on previous quarter now to 66%. The PHEV data is down slightly, and that's because of the absence of the Range Rover Sport for PHEVs also. Next slide, please. Okay, so this is our walk from quarter one last year, and it's telling you what you should expect to see. The significant adverse is on both volumes, down 13,000 units, and mix. Within that mix, there's actually a negative of 170 for Range Rover Sport, and 50 positive for Defender. Our VME continues to be at historical lows, and the pricing actions we took earlier in the year are starting to come through. Inflationary pressures are similar to what we actually indicated in Q4. We continue to have bad news on capitalized engineering. Why? Because our new programs haven't yet come to maturation. We expect that to change as we go through the balance of this year. That's worth about a point and a half EBIT next. And then the bad news on revaluation, because sterling fell to 121 at the end of the quarter. Bad news on commodities, because actually commodity rates for aluminium and palladium, the ones we hedge most, actually also fell as we went through the quarter. Obviously, both of those two things are good news for our operating model. And you can see operational financial exchange, particularly on the dollar, was good news in the quarter. So overall, that walked us from the minus 0.9% EBIT to the minus 4.4% EBIT. And again, this excludes the pension exceptional item I referenced earlier. Next slide, please. Cash, where are we on cash? Minus 769. Most of that, again, is working capital, but the constituents are slightly different. And inventory has actually increased, which obviously from a cash and a working capital perspective in quarter is bad news. But from a starting to build back the pipeline and starting to build back parts inventories, which of course will help with our build reassurance going forward. That's where that money is being consciously spent this quarter. Underlying cash is actually minus 150, and again that points to the weakness in our sales profile, particularly to Range Rover and Range Rover Sport. Next slide, please. Okay, our break-even remains pretty much the same as it was last year on a full-year basis, 80 to 85,000 units in a given quarter. It was, even though we had a weak profile of sales in quarter one, as I've explained already, that break-even point was still 80,000 units. We actually did build more cars than we actually wholesaled, and I'll take you through that in a moment. We ended up by building our inventory, a work in progress by about 8,000 units, which we will complete in quarter two. So that break-even, given the conditions we have, is still really, really low and really, really strong. Next slide, please. This is the investment, a little bit lower than I was expecting by about £50 million. You can see the point there. On the left-hand side, the amount of engineering expense we are capitalizing, it's only just over a quarter of the engineering bill. In the previous year, you can see it was 40%. When we take our new Reimagine architectures, EMA and Panthera through their approval processes later in the quarter, stroke early next quarter, then that will start to lift to a normal level I've given you before, 50 to 60%, and that's worth a 0.5% even. Capital investment is lower. This time last year, we finished off our investments and our Solihull facility for MLA. Next slide, please. Okay. So let's talk about where we were on supply and particularly on production in the quarter. Let me do a second to start reading that, but I'll hit the highlights. So look, we did have some chip supply constraints, particularly earlier in the quarter, but particularly, relevant to the build-out of our old Range Rover Sport. That did delay the completion of the old Range Rover Sport. Many of those units we did actually need to build into WIP, which we're clearing through, actually some of them this month in July. That did have an impact on the transfer of our labour into the new facility, which builds the new Range Rover and the Range Rover Sport. So there was an impact on semiconductors. It was a particular supplier, and the work we've done with that particular supplier later in the quarter has meant we haven't had any further disturbance from that supply source right through to the shutdown period at the end of July. So it shows the long-term contract work we are doing is actually starting to show benefits. We are seeing the light at the end of this very, very long tunnel here, particularly on semiconductors, we feel. And then the rest has been all about our ability to ramp up two new vehicles on an all-new architecture in an all-new trim and final facility with an all-new body shop. And of course, a workforce that needs training and an added shift, by the way. We have added a third shift into that facility because of the huge demand that we have for these products within our order banks. So those challenges are actually quite normal for a changeover point, but they have been exacerbated by the semiconductor point I mentioned earlier, and also the COVID lockdowns in China, which did impact the ability for us to consistently build units, week by week within that facility. A lot of that is starting now to become behind us. I've mentioned the partnership agreement with our key supplier, which has meant no shortages of semiconductors from that source for the rest of the quarter and through the first 3 weeks of July. Our ramp-up is beginning, particularly on the Range Rover, which was the first vehicle, and our production on that vehicle doubled as we went through the quarter from just about 500 units a week to just over 1,000 units a week. Just the points around M&A, the production of the new Range Rover, the production of the new Range Rover Sport, the improvements we've made over the last 6 weeks, where we ended up in July in a much better place in April. Now, with what we see in front of us, and we're now starting to see the capability to deliver 90,000 units to our dealers and importers in quarter two. So a significant jump from that quarter one. Next slide, please. And the orders have kept growing. In fact, they've grown in this quarter larger than any other quarter, marginally larger than the quarter when we announced and showed the Range Rover in October last year. We now got 200,000 customer orders. That excludes the dealer orders, of course. And you can see there our three latest and greatest product offerings, Range Rover, the Range Rover Sport at the bottom there, and the Defender, making up almost 65% of that volume. They are our most valuable brands and most valuable nameplates as well. So we have a super healthy order bank, a super healthy future revenue stream, and we're starting to break through the production issues. And there's starting to be light at the end of a very long tunnel on supplying semiconductors as well. So a lot of that is not reflected in Q1. That's why we're really disappointed, and as you can probably hear from my voice, a tad frustrated about quarter one as well. But we are starting to see those core ingredients move in our favor into quarter two. Next slide, please. And we've also revealed a new member of our Defender brand family, the Defender 130, the extension of the vehicle at the rear, beyond the rear wheels. This vehicle will safely and comfortably occupy 8 adults. We expect it to be very, very popular in our US and some Middle Eastern markets as well. And if you did notice, even though the production at Nitra is closest to a normal level in any of the plant, our demand and orders for Defender increased by 5,000-6,000 units in the quarter. A lot of that was for this vehicle. So it's had an incredibly fast start and appeal, even though it was only revealed a month before the end of the quarter. Next slide, please. Okay, refocus. So we did $1.5 billion last year. Even though it was a very thin transactional value quarter for us, we still did $250 million in quarter one. That was broken down in 3 constituents. You've seen most of that data already earlier in the presentation. The net pricing, the value was $120 million. That's a big constituent of it. We are starting to see labor and efficiency benefits within our agile transformation, particularly within the engineering fraternity. Obviously, we're doing that mostly to ensure that we speed up the quality maturation and the delivery of our products. But of course, the unspoken within there is the cost of delivering them will be lower, also spending less time and less people hours on it. And then the investment number, which was low for the quarter and therefore did contribute in this quarter, but I do expect that to be much, much less in later quarters, and I expect the other constituents to be greater. Next slide, please. So inflation, we'll be talking about inflation, I'm certain, for the next few quarters. We introduced this slide earlier this year, the same slide on the left, 12.5 billion cost base, variable cost base, 4 significant elements within there which are suspect to high inflation levels: labor, marketing costs, semiconductor prices, and energy, of course. And the balance between the pressures have shifted a little bit. We went into the quarter with aluminium at $3,500 a ton. We've come out the quarter with $2,400. Palladium came down as well, $300. That shifted a little bit, temporarily perhaps, from commodities. Of course, we're getting some utility energy cost increases, semiconductor cost increases, and labor cost increases. So the absolute number for the quarter versus last year was £160 million greater, a little bit less than I was expecting actually in the quarter. I was expecting up to 200 million. And some of these headwinds are stronger and some of them are starting to two or three things here. One is we're very confident about the overall scale of the program and what we will do this year. We're confident that it will offset in total the absolute amount of inflation. And as we go into the second half of the year, we expect an even offset also, as most of the inflation pressures we're seeing is then overtaken by the other things that we are doing, including the pricing actions, which will come through later in the year. Next slide, please. This is an important slide, although it doesn't look it. Right. So this is the health of our end-to-end pipeline from build, shipping those vehicles. And if I take you back to January 21, we talked this two or three times before, but I wanted to talk specifically today. If I take you back to January 21, that's as close to a normal, healthy pre-semiconductor pipeline that we have. It increases and falls down because of the aberration called March in the UK, where we build units and then we sell them. So if you draw a line versus the first 3 months, you'll see pretty much 60,000 units in the dealer pipeline and 40,000 units in our pipeline. I mean, 200,000 total units would have been a pre-semiconductor normal environment. And from there, our order bank is about twice of our dealer inventory. That's what we would have expected before semiconductors. Width's about 4,000 units. That's what that blue line is. But width is a subset of the grey line called GLR inventory. We own the width, we own the GLR inventory. That's on our balance sheet. That's a part of the £3 billion that you would have seen if you look at the balance sheet. It really, really fell as we went to our quarter two. You will remember the quarter two, they both fell towards the 30,000 level from an inventory dealer and an inventory GLR perspective. But our WIP also fell to about 2,000 units, right? So we were building cars, but very, very few. We've gradually grown both of these over the course of the last 3 quarters, through to June. And there's been a significant uptick, as you can see there, in June. So what that means, we are releasing more cars into the dealer network, and we are releasing more cars onto transporters, onto trains, and onto ships, and they will turn into retails and wholesales at some point. And we do believe a part of that is going to happen in quarter two. Now, we did end up with 10,000 cars in work in progress at the end of June. 5,000 of those were Range Rovers and Range Rover Sport. And I'm simply giving you more corroborative evidence to the real breakthrough here is in that facility at Solihull, Range Rover Sport. So that should have been 1,000, not 5,000. And we're starting to work that number down, including during that shutdown period this week and next week. And we have high confidence those units will also be released onto those transporters, ships and trains as we go through August and into September. So we are a long, long way away from being normal here, but this is evidence that it's starting to shift back towards a more normal environment, which underpins our 90,000 unit projection in Q2. Next slide, please. So what are the things that are in front of us? I've said them a few times already, right? We absolutely need to continue to make progress in our new facility in Solihull. We're very, very confident we're doing that on Range Rover. We can then repeat that product of the same architecture, don't forget, in Range Rover Sport later in quarter two. Our guidance is circa the 90,000 units, so I mentioned a number of times. We're very confident we both will be £1 billion, and there is a plus there, by the way. I'll be more informative about how much of a plus when we talk in November. Our full-year guidance is still 5% and £1 billion positive cash flow, despite the disappointing and frustrating quarter one. That does mean we need a breakthrough in quarter two, and delivering 90,000 units would be a sufficient breakthrough to underpin that number. And we will then need to break through again in quarter three, and that's where the Range Rover Sport will come through strongly for us, we do believe. Our longer-term targets, of course, on Reimagine, we rarely talk about these, right? Please don't think we're not talking about them, we're not doing them. We absolutely are doing them. 90% of our engineering teams are on Reimagine programs now, and those engineers were released from Range Rover Sport, which is why the capitalization is so low at the moment. attention of our workforce is on future product. We now have a much more concentrated, determined, full-time response to the daily activity, which is starting to see us break through on. And that has been added to again during quarter one because of the challenges we had in quarter one. Free cash flow, look, I'm not walking away from the near debt number in FY24. We have to break through in quarter two. We are running out of time. We just have 21 months. And that means from the end of June, that's an average 200 million positive cash each month. This is still possible. We need to break through with speed. And the confidence when we do break through will underpin FY24 7% plus EBIT. And obviously at that point we'll be in a really nice place to talk to you about how we're going to walk to 10% plus. Next slide, please. Me, Balaji.
The numbers here on the market share side, we clocked a 42.5% for the quarter, and the key call out here is the shift away. That's more than a shift away, the more a shift towards the demand pull supply chain to ensure that the sustainable market share gains are sustainable and focusing squarely on how we are working with the registration market share rather than wholesale market shares. So this is something that we are committed to, and therefore this noise in terms of market share for a quarter or two will be there, but it will get us to a more sustainable pathway of simultaneous market share gains, optimal inventories back to dealers, and of course lower levels of VMEs that we need to put on place. So that's the emphasis there. I'm sure Girish would want to talk about it subsequently. Next slide, please. The key call out in this slide is the mix that you see of powertrains. We would want to watch the ILCV space carefully. We did notice the reduction in the CNG composition. I believe it is nice, temporary nice, as the price of CNG versus diesel arbitrage came down a bit. But let's watch it for a few more quarters before we can take any message out of it. Next slide. Overall numbers, CV turned in a positive PBT for the quarter. And on a year-on-year basis, revenue grew 107%. And obviously, this being a weaker quarter, you can see a sequential drop in terms of revenues. And EBITDA at about 5.5% and an EBIT of 2.8%. We expect this is something that's now starting to stabilize and we'll be able to build from here on as the commodities come off. So that is the thing on CV going forward. In terms of the walk, the P&L walk, you'll notice that we're stepping up FME in line with our plan to move to more full-based supply chain, so therefore working on retail lead. And employee cost of 203 crores, basically just beginning of the year when the numbers reach the bonuses for the year, etc. And what you see is unrealized FX and commodity hedges. We did lose on the rupee depreciation where the hedges on the exports did lose money. And this will then get compensated by the dividend income coming in the product fund. So overall, that piece is the numbers balance each other out. But the call out I would definitely say is look at the line between realizations versus variable costs. This number, if you recollect, is we have priced by 40 pips. So most of the pricing actions have gone through realizations to offset the commodity costs have gone through. And therefore, we should start seeing this starting to improve here on. Next slide. Yeah, thanks, Balaji. So some of the highlights for the quarter, I think the industry continued good recovery and doubled the volume over the Q1 of last year. Of course, last Q1 was marked by the pandemic second wave. But nevertheless, I think good growth showed in Q1. The EBIT margin improved by 690 pips, driven by the revenue growth and also the pricing and cost actions that we've taken. And has also grown 240 basis points over FY22 full year. We continue to see a very good growth in our spares and service penetration, thereby improving the non-vehicle business revenue by 75% over Q1 of last year. And this offers a good profitable stream for us. Our new products, we continue to towards that. I think we are seeing signs of softening after a good upward run since second half of last year. Coming to the passenger segment, finally we are seeing return of demand. So with the staff movement, there is employee transportation cost. And factories back in place. There's also tours and travel and specifically opening of schools has led to good demand, and the volumes grew by 60% over Q4 last year, which is the quarter gone by, and almost four times that of what we had seen in the first quarter of last year. So very good demand coming back, although this is still lower than the highs which were achieved in FY19. Already spoke about the retail push that we have initiated, and I can tell you that we had the highest retails in small commercial vehicle and pickup in Q1 of any year for almost last 10 years. Going ahead for the focus areas, I think our international markets demand has been impacted, especially in SAARC as well as Sub-Saharan Africa, essentially due to steep depreciation in the local currency, along with fuel price hike, and of course Sri Lanka, all of us know about the political turmoil. In these circumstances, we are looking at alternate markets and products to see how we can get back to the required level of volumes for international. I spoke about the retail acceleration and what of demand pull to ensure that we actually have sustainable gains going ahead, sustainable share gain. The lot of push on the digital lead generation, and I can tell you that 20% of our volumes are now coming from leads coming from digital in small commercial vehicle and pickup. With the interest rates increasing, I think we'll continue our engagement with the key financials and trying to find out ways and means to see how we can support the customers in this environment. We started the margin improvement journey towards the second half of last year. We continue to do that, and it's being driven by both pricing actions as well as the cost savings, and the fundamental margin has improved quarter on quarter from Q4. Next slide. Update from the new businesses on electric mobility. I can inform you that traditionally 100 electric buses were delivered in Q1. So now we have cumulative 750 electric buses running on Indian roads and cumulative coverage of more than 40 million kilometers. So that's a good experience that we have and over 90 cities in the country. We are also working on the fuel cell electric bus, as we've been mentioning, and the program is on track, and in fact we had first milestone review with IOCL, with whom we are working jointly, and this milestone has been completed successfully, and both the factors were quite happy with the program. We did foray into the last mile e-mobility on the cargo side with the launch of and we have more and more understanding for our 39,000 units. We already started customer trials, and towards the end of this quarter, we will also start delivery of products. Going ahead, we also incorporated the global smart city mobility distribution limited as subsidiary and operationalized 53 buses in Delhi Transport Corporation. And as a part of the smart city mobility solution, which is a cross contract model or own and operate model, we are now managing 450 buses, more than 450 buses, and delivering more than 96% of time. And all of you know that we were declared L1 for the largest global tender, more than 5,000 buses, and now we have received LOA, that is letter of allocation from Delhi Transport Corporation, amongst these Q1, the industry wholesale increased by 41% year-on-year as the semiconductor supply chain. The quarter sales were quite healthy at 9 lakh in the quarter. Segmental shift towards SUV further strengthened. It was at 40% in hatches, continued to share from 37% to 34% the last year. As far as Tata Motors is concerned, we continue to strengthen our market share in the maintain the trend of quarter-on-quarter market share. While the PV ICE business grew by 102%, the EV business grew by nearly 5%. The wholesale and production milestones, we crossed the milestone of 150K last month of quarter. We also crossed one of the major milestone of a monthly sale of 5,000. As far as EVs are concerned, we posted the highest EV sales of 9,000. So despite the stress that we faced on semiconductors the first half of the quarter, the market share remains strong at 88%. Now, several months now, we continue to be the number one SUV in Samsung. That was the case in Q1 FY. Next one has been trending as the most SUV in my 5 or 6 SUVs that we have. To further strengthen our supply side, we signed a tripartite MOU in government of Gujarat for the potential acquisition of the ports and the discussion about the two will be going forward, as far as industry is concerned, we will see that for this financial year, industry will be 3.5 billion. EV demand is going to continue to remain strong with I feel positive word of mouth of nearly 40,000 EV customers that we have today. As far as Tata Motors is concerned, at the start of the Q2, we have a very robust booking pipeline and no channel inventory, which boils well for quarter 2. Demand for SUVs remains strong. We have a very strong booking pipeline also. There has been a good traction of CNG, which continues. We expect the vehicle supply to improve with better semiconductor availability. Rural demand is expected to be strong on the back of good monsoon. The Nexon Mini Max, which we launched in May, has seen tremendous response and has augmented the EV demand. And supplies are expected to increase importantly. Going forward, the challenges we see is that high inflation interest rate will start impacting the competition. While there's no stress as far as Q2 is concerned, until the festive season, we don't see a consumer bubble. We also don't see as far as the damping of demand is concerned, but given how the retail industry is getting impacted because of these factors, we have to be a bit watchful. And post the festive season, we will witness less of how the industry is. As far as Tata Motors is concerned, we again focused on demand generation activities with now segment level and maintain our focus. We continue to enhance the supplies further with the semiconductor availability also improves and we fast track the cost reduction effort. Thank you. Thank you, Shailesh. Like quickly on to the cash flows by the ordinary estate that goes straight into the Tata Motors bank for the next one. Yeah. So here, callouts here, collection efficiency started to improve now at 98% for June, and therefore GNPA will keep improving with every passing quarter. And fully compliant with all the LPCA norms that RBI has put in place, and both capital adequacy and liquidity remains comfortable. And the aspiration is to take that ROE from 5.1% all the way up to double digits in the foreseeable future. Next slide. So coming on to the outlook, key callouts, demand remains strong and we expect to remain strong despite inflation and geopolitical situation. Obviously, we watch the Indian CV situation carefully, but right now we don't see any cause for concern at this point in time. Chip supply is expected to improve further from Q2, and therefore added with the cooling commodity prices, that should also help in underlying margin. And therefore, we do aim to deliver the strong improvement in EBIT and free cash flows from Q2 onward. One of the key things in this is what we intend to working on. Happy to take any questions that you may have. I already see we have got 13 odd questions that have landed up already. Let me start. I think Girish, the first one is coming your way. This is from Sohal Gupta, LNT Mutual Fund. MNCV market share is now down to 54.6% in Q1. Is there a level at which you expect this to stabilize? And what are the risks that the commodity benefits are taken away in that CV business? Commodity benefits are given away in the CV business. Okay. So first of all, the market share trends. I think over the past 2 years, we have been consistently growing market share in MNCV. We've seen some softening happening in Q1, but we're determined to get this back. And on the back of various actions that we have, both on the demand generation front as well as launch of new products, I think we should be getting it back. So certainly not satisfied at this level. As far as the commodities are concerned, the commodity margins are likely to be given away due to intense competition. So I think we have a comprehensive margin improvement plan running, which is working on both the flags. That is how we improve the realization. This is delivering more value to the customer. And the second thing is how we keep on shaving off cost. And one of the cost benefits is the commodity reductions, which are likely to happen. So we will see how it comes. And also, just to add to that point, if you look at the outlook, specifically calling out and reach double-digit EBITDA earlier, so that's clearly an imperative for this business. Okay, next slide. Next question from Dinesh Nandi on JLR. I think it's coming your way. How should we think about things for JLR after the ramp up and bring over Range Rover support in better, but also just supplying it better to improve? Should things further deteriorate over first quarter levels? The second question, we expect and increase in wholesale from second quarter from the 90K levels that we've seen. And lastly, which line items does it affect the valuation after related commodity hedges? Three questions.
Okay, thanks, Balaji. So, the mix was really weak in quarter one. Range Rover mix was about 8% of that 70,000 units. Our order bank is telling us that between Range Rover and Range Rover Sport, 40% of the order bank. So there's a significant improvement of mix that will happen once we start to overcome those issues we've referenced significantly in the quarterly results so far. So I absolutely anticipate mix not only to improve in quarter two, but to continue improving through the balance of the year as those production challenges continue to reduce. Do I expect a strong increase in wholesales from Q2? Look, I expect each quarter to be better than the quarter before. That's no different, actually, to what I've been saying for the last 2 to 3 quarters. I did expect that in this quarter also, actually. So if I'd have put a number on the data last in March, that number would have been 70,000 high rather than 70,000 mid, and the difference would have all been Range Rovers, and that would have actually started to shape the quarter much closer to the level of EBIT stroke cash loss I was inferring on May the 13th. So I do expect each quarter to be better than the last. I can see the data for the first 3 weeks. We're now building consistently above 7,000 units a week, and we're building consistently week on week on week. That will increase to the 8,000 units plus, which we will need in this quarter when we start building Range Rover Sports. We haven't built Range Rover Sports for 6 to 7 weeks apart from a few units just to improve and try it. That will begin to happen post-shutdown from the 8th of August. So we're pretty confident, actually, with what we see in front of us, that the build will grow from 7 to 8,000 units a week. We have 11 production weeks in the quarter. That gets you close to the 90,000 units. And we have 10,000 units in width, which will reduce. And therefore, that's why we're saying we think the wholesale number will be 90,000 units. Which line item does FX revaluation? Well, it appears down the whole stuff. So it's significant on revenue, of course, as we bring all of the overseas revenues into sterling. It's significant on cost, of course, because so much of our cost base is sourced in overseas currencies, around 55%, a lot in euros. But it's line by line. So if you take marketing no our exchange losses. So it's down the whole stuff.
Thank you. Thank you. Next question also from James Gandhi, the fan on Gilway. What's our capacity and capacity of the FGD? What is the scope increase capacity in the quantity? So, we are pretty much operating at full capacity in Ranjangaon and Pune. We have some headroom in common plant is concerned. Further, debottlenecking as we are actually and we see a additional possibility of 10 to 15% for the debottlenecking. So that's as far as each capacity is concerned. We are further working on food. Thanks, Shailesh. Girish Yahweh, I see success in demand for small fleet operators. Yeah, so two things I would like to say. First is the sentiment index that we measure is at a high, and that is an indication of interest from both large as well as small fleet operators. Also, if you see the intermediate and light commercial vehicles as well as small commercial vehicles, actually the small or retail customers, single vehicle owners are the buyers for these vehicles. And these segments have grown more than development needs. So actually the small fleet owners, single vehicle owners are still in the market and not likely to see softening immediately. The point of inflation because they expect commodity prices to come in the second quarter. We will see commodities starting to go up, and you should start seeing this coming from second half as the current hedges now as well as all the contracts are start coming. So let's see how it plays out. Next question is what are the systematic any specific segments or see the EBITDA margin Q1 FY 2026 cut was largely similar to Q4 coupled with softening iron. Yeah, so I think 2 points I would like to make. So one is of course the scale impact. So the revenue has actually gone down by 8% from Q4 to Q1. So that is one of the reasons. Second is the MSCV volumes have come down by more than 20% from Q4 to Q1. So this certainly has an impact on the margin. But what I would like to say is on the back of the pricing and the cost reduction actions that we've taken, the fundamental contribution or underlying contribution margin has actually improved over Q4 of the last year. Thanks, Girish. Next question is to me actually on India e-bus order when can you take us through how the GBP order was with the amount in the financial? So there are two things here. One is Tata Motors standalone, and then there is a subsidiary Tata Motors Smart Mobility Solutions Limited. So there will first be a sale happening from Tata Motors to Tata Motors standalone to the Smart Mobility Solution. This will be considered as a sale in the standalone books, but in the consolidated books, this will cancel each other. The revenue will not be reflected. Number one. Number two, this asset continues to remain in the Smart Mobility Solution books, and the collection will happen over a period of time as the bus starts running, and therefore there is revenue recognition happening on the in terms of rupees per kilometers, in terms of number of kilometers that it traverses, and that will be the Smart Mobility Solution books. Against this, the running cost, operating cost, etc. will be set off again. Over a period of time, what this particular, so obviously the next question is also still keep building assets which are books, answer is yes. And over a period of time, once the collection experience has been established, then you'll be able to take this as a copy of books. You'll be able to turn on the there are multiple options out there. And there are also other conversations that are happening with the government to find a way to actually reinvent this as the intention itself. And those you should start seeing some results of those deliberations in the coming year. And definitely before the next tender that comes out of this side. But there are a lot of possibilities of how to actually lighten the balance sheet and reduce the collection risk and the solvency risk of this. The next question is from Pratik Kodar. for the 10 we've already done. So, and on the PV division, looks like the model cycle tailwind for us is over. Although model refresh can be uneven. Is there a concern within the team that the market share loss might be a possibility going forward unless we start with a new model cycle? Correct? Yeah. So I think you're well aware of the intensifying competitive landscape country and stating our share. I think we have 2-3 points here to share. One, that you rightly mentioned that cycle plan or these MCs and the refreshes, the cycle that we'll see in the next 2 to 3 years starting next year. And that should not only help us sustain but slightly grow our market share. Also, right now, the share growth at which we are is slowly shrinking because we are still as a very early stage. The second major lever for us would be the power points. We have a unique position. We have a unique position where we have all the 4 powertrains: petrol, diesel, CNG, as well as electric. And therefore, we are at the sweet spot of the route that we are going to see the next years as far as CNG is concerned. So that should give us with the current models and with the expansion that we're going to see against in this space as far as electrification and the more CNG models. We will witness our growth in this segment because of our unique position of having multi-powertrain option. And third is, of course, we have to add Indian plates. There are certain gaps in our portfolio which are going to fill in the coming years. One of them we have already shown to you, which is the concept curve, which we had been different. Still coming, while it is going to come with the first as a medium, but it is also going to come with the increased curve also. And there will be additional nameplate which we will answer the right time. So, mix of all these actions is going to ensure that we continue to get our market position. Next question also your way. What's your backup plan in case hybrids become effective in the India PV market? So as a company, we are closely watching how option hybrid takes place. But see, one thing we are very clear that the long term drivers of the oil industry as well as community position and issues that we have as far as oil industry is concerned, as well as the driving traditions, it is the long term. Therefore, as a company, we are going to remain focused on these. Having said that, in the later part of this decade, as the emission norms are going to become more stringent, there will be a degree of electrification that will require in the currentized vehicles. And therefore, as an organization, we will keep ourselves. There's also a question on pricing. Are we not seeing that price is similar to hybrids or a price premium so that the value proposition of EVs can further improve in the hybrid environment? I have no view of the hybrid prices, frankly, because we are going to launch hybrid, strong hybrid and so far there have been normal hybrids or even lesser than mild hybrids. We can see how the pricing pans out. But as you've already seen that we have bounced up in which are 20 to 25% price, which is that related to the current petrol and diesel model. So it's already very competitive. I'm sure that this pricing will be competitive to a hybrid option that is going to come in the market. But let's see, the pricing when it gets announced. Thank you. Next question from Hitesh. How does the steel contracts pricing include Q1 higher than spot price? And if you take the steel cost at spot prices, can the margin be higher? So typically our steel contracts are for a period of 6 months, but due to the recent volatility, we shifted to 3 months. So we have been doing steel contracts on a quarterly basis. I can tell you that the spot prices are much more volatile and generally higher than the contracts that we have with the steel. Thank you. Next question, Jayana, it is coming your age. Is it possible to reiterate the sum of what was the margin pressure beyond the one-off nature? Sorry about it. Carry on. Okay, thank you. Yeah. So, look, we pointed towards this. It was particular around the Range Rover and Range Rover Sport facility. We only
Is it one-off in nature? Well, the binary impact of very low production on Range Rover and almost zero production on Range Rover Sport is absolutely, a binary impact in quarter one, which will progressively improve. So margins will increase as well.
Carry on. Yeah. The next question is another one depending on the long production rate, which you already covered it. Let's go to the one on gauges. When does the adverse impact of gauges start affecting operational numbers?
So it's already affecting the operational numbers, Balaji. I think if you went back to our walk, our EBIT walk, our profitability walk, I think it would have said that the operational exchange was 210, and the impact of those hedges was about 115 versus previous year. If I give you the rate, actually, the effective rate in Q1 was about 128. Our hedges is in place going forward just over 130. So on a quarter-by-quarter basis, we have got hedges around the 130 going forward, but it's not too dissimilar to the effective rate in Q1.
Okay. The next question is from Raghunandan NT Global. Currently, this is anything indicate commodity impact in Q1. I've already called out what is the commodity impact. Look at the rate pricing versus realization. Like the realization was a variable cost. And you will see about a 30-40% to be recovered. But we believe this will come up as we go forward. As far as the e-buses, the companies on large orders, what kind of equity infusion is planned in the company that is owned the e-buses that supply lower and cross contract basis? Obviously, this will span out over a period of time where the buses have to be delivered by the FY 24 onward. But there is a fair amount of time in front of us and we'll do it on a sequential basis. Then we'll let us think through the equity and debt combination to get that right as well. So leave with us at an appropriate time we share with you. This will not complicate the calculations on getting net debt free. So you can rest easy on that, but we still like to back the fact that this is at the beginning and there's a lot of work underway to get that back. How do you see the M&HCV industry outlook for this year? Right, so I'm the chair of CNG vehicles. Yes. So let me take the first one on M&HCV. I think this would be the fourth quarter when we've seen successive growth that has happened in M&HCV. This is happening on the back of upfront infrastructure spending by the government, using freight rates, fleet utilization, planning. Most of the things seem to be falling in place. As I mentioned in the presentation, I think we are keeping a watch on two monitorables. One is the fuel prices and second is the interest rates and see what kind of impact it will have. But as of now, I think it appears that we will see double-digit growth in M&HCVs for the entire year. As far as CNG vehicles are concerned, I think over the past 3 months, the competitiveness of CNG price has gone up significantly with respect to diesel, although the gas will remain. But as a result, you've seen that the CNG sales, which used to be around 40% in our ILCV portfolio, has already come down to around 25 to 27%. So this is something we will also keep a watch on how the relative pricing between diesel and CNG plays out. I think as a company, we are ready for the portfolio either between diesel and CNG and ensure that we ride the one which is required in the market. Category. Retail is coming your way. Slightly different question on the production point. Have there been any change in booking or the cancellation rate? And there are a production rate of other peers are rising ahead of us, or particularly this quarter when we had a challenge. And then the next point that you have covered is why is dealer inventory generally rising for the last 2 quarters despite all rates have been on a backlog. And any impact on the incremental demand due to the global economic growth factor.
Okay, Balaji, let me take the first one. Look, when you study those order banks, I think a couple of things are quite evident. The 3 nameplates, the newest product, including the Defender, of course. Now, the orders for those 3 nameplates just keep growing. And there's several reasons for that. I mean, we're not building as many as we need to, of course. That's one piece many on the road either. And that means we anticipate that the orders for these three nameplates, particularly Range Rover, Range Rover Sport, will continue to grow. And the risk of cancellation on those nameplates is very, very low. I think there is a disparity when you look at the other nameplates we have. The orders for those other nameplates, if you notice, that data has stayed pretty flat over the last 9 to 12 months, around 70,000 units in total. We haven't built to the level we can build there, so I think it's pretty clear that once we can build all of the Range Rovers, Range Rover Sports, Defenders, Velours, Evoques, then, once we go to a normal level of production, we will need to stimulate demand in some of these other nameplates, the lower transacting value nameplates, the SUV2 and SUV3 sectors, and also Jaguar sedans as well. But we are months away from that, we feel. Any cancellations we're getting are more in those lower value transacting nameplates. And there may be a link to question 3, which is a subset and a part of that, but that's unclear for us because it isn't that substantial yet. I think in question 2 about why has dealer inventory been growing, just think of our global profile. As we build more Range Rovers and Range Rover Sports, and we have been, and I mentioned earlier about the slide, if you can visualize the slide about where do we actually sell those, we sell those mostly in markets which are far away, China, US of A, and of course we own that inventory until that inventory is passed through ports of entrance into those markets. So, from dispatch from plants here in the UK right through to the point of receipt in Shanghai, receipt west, east and west US of A, that's on our inventory. So it's actually evidence that those cars are on the way. That's why it's growing, and it will continue to grow beyond this point when we get back to a normalized level, perhaps another 5,000 or 6,000 units. So it's actually a healthy sign, even though it may not look it when you read the context.
Thank you. Next question is from Pramod Kumar, UBS. Again, this is coming away again. Can you indicate the transaction price for the new Range Rover versus the old Range Rover, given the significant upgrade to the model?
No, I can't. Look, I think this real data will show itself in 2 to 3 quarters' time. We're only built 6,000 cars. We've got 67,000 orders, 80,000 across the two, almost 90,000 orders. It will be a great question when we get to Q4. But at this point in time, early orders, the richest value orders are the most complex and the most difficult to build. So there's some of the ones which are still sat in their work in progress. Any data I give you will be misleading. It's going to be bigger, right? You know it's going to be bigger. Those transacting prices are going to be bigger, and they're going to be moving with close to zero VME. So they're going to be a really rich, healthy part of our portfolio going forward.
Right. We talked about the macro, so I would skip that question coming your way, Shailesh. Auto and finish. Auto backlog for India, PV and CV segments. Yeah, so PV, I wouldn't add there's no order backlog, but PV is a more relevant one. Yes, so we have a very strong order book, as I mentioned in my presentation also. And it ranges, on an average, it's about 2.5 to 3 months of the average sales that we are doing right now. As far as the various models are concerned, for PV, it varies anywhere between 2 weeks to 3 months. For EVs, it is higher, especially for the Nexon Mini Max. The average waiting period would be 7 months in advance. Okay, the next question is from Kapil Singh, Nomura. We talked about recession risk. Do we have order books demand recovered? India PVCV commodity we've talked about. I think same with Gulshan. I think we've talked about all the points that she has raised in that DSL funding, model share, power mix. I think we talked about everything. Just go down. Question of Satya Thakur, Credit Suisse. Even global luxury OEMs, including JLR in GP per vehicle, rise significantly over the last 15 quarters. Do you expect the usage demand commodity environment to inherently boost unit profitability, or do you see industry using lower cost environment ahead to can support demand amidst a global growth concern? I think this is probably right up your alley. GP per vehicle. The gross profit per vehicle, given the contribution margins have gone up, with lower commodity costs coming in and more profits coming your way, do you expect to take it to the bottom line, or do you expect to stabilize the market?
Well, what we can see at the moment is that in our segments, the offer, the supply is not at the right level compared to the demand. That's the first element, and people need to understand. So there is, we can see as far as we're concerned, that the demand continues to increase, despite we are increasing the pricing. And just because there is scarcity, and because of the desirability of our products, as such that there is a kind of matching happening. Demand increase and pricing increase at the same time, because we see that our profitability is also increasing, and you can do more than compensating the inflationary impacts that we can see.
Thank you. Thanks, Jerry. I think I've already arrived at the last question. This is from Piranjan at HDFC. So this is your question. Does it make sense for the company to think of a nice variant of the entire taxation structure gives us much leeway to price the vehicle within 500 kilometers range with the price point?
Absolutely, it makes sense that we look at it with both ICE as well as EV. I think that there's still going to be significant difference between the EV as well as ICE. But the attempt is to keep the premium that we have been keeping on the EV versus ICE, increase the range, as we are able to take the benefit of taxation, as you rightly mentioned, at the same time, take the benefit of any battery price reduction. So it happens right now. We are seeing a slight spike in short term. As it keeps on going on, by the time we launch, we expect that we'll be able to deliver better range as compared to what the current EVs are. Therefore, it makes sense. At different price points, you trigger demand for different customer segments. Of course, there will be customers who are very, touchy about certain powertrains. So I think we would like to give all the options to our customers.
Thank you, Shailesh. With that, we come to the end of the Q&A session. I think once again, thanks for your time, all of you. I really appreciate it, and also for the questions. As we start off, we can end this quarter on a disappointing note. At the same time, a very clear plan of action and a pathway in front of us in terms of how to deliver the rest of the year in a very strong way.